Have you ever really stopped to think about what happens when you write a check or even just tap your card? I mean, it feels so simple, right? But underneath it all, there's this incredible hidden world of legal rules that makes it all work. Today, we're going to pull back that curtain and explore this secret pact you didn't even know you made with your bank. Let's dive in.
I mean, seriously, think about it. How can this flimsy little piece of paper have the power to tell a massive financial institution to just move money, sometimes thousands of dollars, out of your account? It's not magic, not at all. It all comes down to a really powerful legal framework that we're going to unpack right now.
You see, the second you open a bank account, you're not just getting a place to keep your money safe. You are officially entering into a formal legal relationship, a contract. And like any good contract, it's a two-way street with very specific duties and responsibilities for both you and the bank.
And here's the absolute heart of it. The law defines this whole relationship as one between a debtor and a creditor. Now, put simply, a debtor is someone who owes money, and a creditor is the one who is owed the money. But who's who in this situation? Well, this is where it starts to get really interesting.
Okay, check this out, because it's a little counterintuitive. When you have money in your account, when you're in credit, you are actually the creditor. You've loaned your money to the bank. The bank is the debtor. It owes you that money whenever you ask for it. But the very second your account goes into overdraft, bam, the roles completely flip. Suddenly, the bank is the creditor, and you're the one who owes them. This constant dance, this shifting of roles, is the absolute bedrock of your entire relationship with the bank.
So, since this is a formal deal, it has to have rules, right? Of course it does. There's a whole set of duties and responsibilities for both sides of the table. Think of it like the rules of the game, and you gotta know them to make sure your money is protected.
Let's start with the bank's side of the bargain. I mean, they're the financial experts here, right? So the law puts a pretty heavy responsibility on them to protect you and your money.
Your bank has a few really key duties that are totally non-negotiable. First, it must honor your checks, as long as you have the money in your account, of course. It has to maintain strict, and I mean strict, confidentiality about your finances. They can't just up and close your account without giving you a fair heads up. And they have to give you regular statements. Now, these aren't just suggestions for good service. They are legally binding duties. If they messed up, they're in breach of contract.
Okay, but it's not all on the bank. It's a two-way street, remember. As the account holder, you have some pretty important responsibilities too. This is your side of the pact, and it's all about helping to keep the whole system secure.
Your big job here is pretty simple. Be careful. You have a legal duty to write your checks in a way that makes it hard for someone to sneak in and change the amount. And, super important, if you realize your checkbook is gone, or you spot a signature that isn't yours, you have to tell the bank right away. Your cooperation is absolutely crucial in stopping fraud before it happens.
All right, so we get the relationship, we get the rules. But what about the tools we use to actually move the money around? We're not usually walking around with stacks of cash. We use something way more sophisticated, special, legally recognized substitutes for money called negotiable instruments. A negotiable instrument. It sounds complicated, but just think of it as a legally supercharged IOU. It's a written promise or an order to pay a certain amount of money. And here's the magic part. It can be transferred from person to person, almost like it's cash itself. Let's look at the most common ones.
First up, of course, the classic check. This is a direct order written by you telling your bank to pay a specific person out of your funds. Simple enough. Then you have something called a bill of exchange. It's kind of like a check's cousin, and you see it a lot in international trade. It lets a seller in, say, Germany demand payment from a buyer in Brazil using banks as the middlemen to guarantee the whole thing goes smoothly.
And finally, there's the promissory note. This one is the simplest of all. It's not an order to a bank. It's just a direct, formal, written promise from one person to pay another. It's the ultimate IOU.
Okay, that was a lot of theory. Let's bring this all down to earth and make it real. We're going to use the good old-fashioned check as a case study to see how all these roles and rules actually play out in real life. Every single check has three main characters in its story. The drawer, that's you, the one writing it. The drawee, that's your bank, the one being ordered to pay up. And the payee, that's the person or company who's getting the money. Drawer, drawee, payee. That's the whole cast. Now, this next part is super important. Not all checks are created equal. An order check is made out to a specific person, like paid to the order of Jane Smith. This is much safer because only Jane can cash it or sign it over to someone else. But a bearer check maybe one made out to cash, is way riskier. Why? Because whoever is holding it, the bearer, can cash it. It's basically like pre-signed money. If you drop it, it's gone.
So have you ever seen those two little parallel lines drawn across the front of a check? You know the ones I'm talking about. They're not just some random decoration. They are a simple yet incredibly powerful security feature. It's called crossing a check.
And here's how it works. By drawing those two lines and maybe adding account payee only in between, you're giving a very specific legal instruction to the bank. You're saying, do not cash this over the counter. This check must be deposited into the bank account of the person it's made out to. This one tiny action creates a clear paper trail and makes it so much harder for a thief to get your money. It's a brilliant little security hack.
So after all of this, debtors, creditors, duties, crossed checks, why does any of it really matter? I mean, why do we have this whole complicated legal maze for what feels like a simple transaction?
The answer really boils down to just one word: trust. The whole system, the debtor-creditor relationship, the duties you both have, the rules for these money substitutes, all of it exists to create a system that's predictable, reliable, and safe. It allows all of us to trust that our money, whether it's a piece of paper or just pixels on a screen, will move where it's supposed to because we all agree to play by the same set of rules.
And that leads us to a final big question. For hundreds of years, these rules were built around physical paper. But today, money is just data zipping around the globe. Yet, even when you tap your card, there's still a drawee, you, a drawee, your bank, and a payee. So the question is, as we go deeper and deeper into an age of instant digital payments, will these old-school legal ideas even matter? Or are we going to need a completely new rulebook for the digital age?